Hey everyone, my name is Mike Horwath and welcome to Mike's Market Minute. 2025 has been all about politics and markets, and last Friday was no different when Moody's became the third rating agency to downgrade US debt from AAA, the highest rated, down to AA. Naturally, investors and really consumers in general were surprised by this change. And what does it mean? Well, let's talk about it this month on Mike's Market Minute. So let's start with the obvious. Over here at Diversified, we're not that surprised by the rating downgrade because back in 2011, S&P did the same thing, and so did Fitch back in 2023. Over the last several decades, U.S. fiscal conditions have been worsening, and these rating agencies have followed suit and downgraded U.S. debt. As you can see here, our federal debt to GDP ratio, which measures U.S. fiscal debt relative to your GDP. So if you can grow, this ratio becomes less and less. The concern is if you don't grow and you just pile on debt, naturally it's an unsustainable debt level that your country is now burdening, and your credit rating will follow suit. From an investment perspective, a big reason that we're focused on this is that we do believe that the best way to get out of it is to continue growing, right? To focus on the GDP growth aspect. And how do you do that? Well, we'll talk about it in a second. Some of it is fiscal stimulus. Some of it is trying to provide stimulus for growth within the business sector. And really, all of that should be conducive to equity markets, more even so than fixed income markets. And you've seen things like US Treasuries take a hit. More than anything, at the end of the day, we think the conversation is going to turn itself to the most recent conversation on the political side, which is really budgets, right? Going from tariffs to the budget conversation is going to be a big one. And let's go into why. So should we expect anything different on the fiscal side? Our answer is probably not. The expectation is that the Tax Cuts and Jobs Act, the tax cuts that came along with it, will likely be extended. Corporate rates are likely to remain pretty low. Regulations likely to be rolled back. And it's hard to imagine Social Security, Medicare, and Medicaid really being touched. So the reality is we don't see a whole lot of room for fiscal conditions to remain more balanced or to get more balanced. So the question becomes, what happens to fiscal conditions here in the US? What are our options? And what should really investors do with that information? And we fully expect that deficits are going to continue. And the question for us, and really what our opinion would be, is how do you grow your way through it? We believe that the US should continue to focus its attention on how to drive GDP growth, because as you saw earlier, when measured against GDP, you can mitigate running these fiscal deficits by growing your economy. Inflation will also have an impact. The US probably needs to make sure that we have some, albeit low, inflation to help inflate the impact of rising debt over the course of time, especially as world's currency. So as investors, we think about an environment where we believe we need to focus on growth and slight inflation. This is why we are conducive over the long term and why investors should own equities. Equities do a very good job during times of economic growth, and equities can also help fight the impact of inflation on portfolios. Where we would focus some of our time to avoid would be long-term treasuries. I think investors need to be careful on expectations around long-term treasuries and how much they can fall over the long term when your government and the debt that you are buying is running consistent fiscal deficits. As you saw with this ratings downgrade, you saw bond yields increase, meaning investors sold off US debt and they're going to require compensation for taking on the credit risk of the US government, even though it is the safe haven asset. So investors should always remain diversified, in our opinion. But we also see this as a reason why you should be conducive on owning equity markets and relying on equity markets to help grow yourself out of this, as the US will rely on likely growing and inflating its way out of its debt problem. So as always, if you have any questions, we're always here at Diversified to help answer them, or happy to have that conversation on how it relates to your portfolio. As always, thank you for the trust you put in the Diversified team. I'm Mike Horwath. Thanks for sitting in.